Joining us with more today, New Street Advisors founder and CEO Delano Saporu talks about, obviously, it's a huge story, and it might actually be a tentpole on the overarching discussion of the global economy. Delano, how are you processing it?
Morning, Carl. I think I am processing it in that way. If you look at what was mentioned by the FedEx CEO and just in general what you're hearing from tech CEOs talking about being more cautious in how they're spending money, I think everyone is kind of being cautionary this time, and it's rightfully slow. If we're seeing, especially with the early bellwethers, demand slowing, I think that does trickle into other areas, especially in the tech sector. We already know that where valuations are just based on what's going on with interest rates. So that has to play a part, and investors, especially myself, that's something that I'm heavily looking into and how that's going to affect, especially the tech sector.
Really? I'm looking at Meta today, 146. This has been a very tough week for megacap tech. Does that change your long-term view on a lot of these names?
No, it doesn't. It doesn't change the long-term view. I was maintaining that the next 2 to 3 quarters, we're going to see, a lot of struggle and volatility in mega cap and growth. And I think we saw the CPI come up for August. We're still seeing inflation relatively hot, and I think that still points to a hawkish Fed. But that, for growth and tech, we knew that. But the course of action for a lot of investors is still looking at opportunities when we see a big move of 5 to 10% like we're seeing over the last couple of weeks. Those are opportunities, but rather staying patient and not being emotional to get out of for the long-term positions, I think, is the play.
So, Delano, part of the FedEx story is this deterioration that they're seeing in demand. Another part of it, though, is how well equipped the management is there to deal with that. So when you look at an Amazon, shares are down in sympathy today. They've really been looking at this problem all year. They started the year early on saying that they had overcapacity issues, overhiring, and they've been adjusting for that. So could Amazon kind of be more insulated from this? And that's important, of course, because the mega caps make up so much of the S&P and the NASDAQ.
Exactly, Dee. I definitely think Amazon is more insulated. I have positions in both, and obviously more position in Amazon. And I think that's not only because I feel like the management will be better positioned to handle any supply chain issues and to handle, obviously, weakening demand and to make sure that supply gets to the demand that is there. They also are a diversified business, and that's something that plays a part here where, if you're obviously dealing with cloud and different areas of business that is still going to hold steady, maybe more steady than something that's really tied to the consumer and discretionary, that is going to bode well. So they're trading down in sympathy, but I think they'll weather this storm a little bit better than, say, a FedEx.
Better than a FedEx, sure, but maybe we can take a step back for a moment because it seems like the narrative really has shifted in a significant way over the past few weeks. We're 2 weeks away from Q4. I'm wondering if we're going to have some tougher comps because a year ago, supplies were tight and holiday season started early. Everybody was saying go out and buy your stuff earlier while there's supply, make sure you buy. So people were buying earlier, not necessarily going to do that this year. And then plus from the enterprise side, even enterprise software where it's seen relative strength, I'm hearing from CEOs, in our sales pitch now, we're going to have to argue rip out and replace. Rip out your expensive stuff, replace with us. It's not that the pie is getting bigger. It's that we feel like we're growers and we can still grow somewhat in a perhaps even shrinking environment. Isn't that significant?
Very. It's very significant. And you mentioned just the rip out and replace. The tech companies and the mega cap that perform well are the places that are being more aggressive with sales and are able to win those big deals. And I think you could obviously say that a Microsoft and an Amazon, they're in those conversations. And, I definitely think everyone in this area, in this environment, is looking at, how budgets are being slimmed down. And so that's going to play a part. But, the next couple of quarters, as I maintain, is just going to still be rough. But that doesn't change the long-term valuation, I believe, for tech in the long term.
Yeah, and I just wonder where it bottoms out. What's the next major data point that you're watching for to give us a sense of what kind of Q4 we might have ahead?
I think we kind of talked about earlier, it's not always about interest rates, but looking at what the Fed is projecting for where interest rates will be out in 2023, that is actually a good thing for investors to look at because that's going to give us a tell. Because I feel like the market we've all been a little bit too. The Fed's been telling us to be hawkish, and I think investors have kind of not believed everything been saying so far, and you're having some names come out and say we should be, looking to be deflationary. So I think seeing what the Fed is saying in this next meeting is important for investors. Looking at other earnings, because as you mentioned, we're obviously getting to Q4. Q3 earnings are going to be pivotal to see how we perform for other companies where demand is and what they project for the future, for the rest of the fiscal year, is going to be very, very important.
Shepard Smith here. Thanks for watching CNBC on YouTube.